Discuss about markets, strategies, and also key portfolio allocation. I have with me Bala, CEO of Birla Sun Life AMC. Bala, fantastic to have you back in our studio. Thank you for joining us.
Thank you.
It's not looking all that great. I mean, we started the year with a lot of promise. It was a dream start to financial markets, and now suddenly things are looking shaky. Across the board, portfolios have taken a hit. Good news is that domestic institutional investors don't have redemptions, but the bad news is that portfolios have got damaged.
Correct. I think the last, since November last year, this has been a challenging moment for money managers, both for equity as well as fixed income. So, one side we have seen the interest rates rising, and initially it was it's a more of a global trend. And India too, actually the interest rate rising trend now has begun, especially post this last rate increase that we saw in the last monetary policy. And apart from that, on the hope of expectations as well as high optimism which got built in the last 2.5 years, the market ran up quite ahead of the curve, but the earnings are not coming forth. And with this change in the macro dynamics, both globally as well as from India point of view, some of the macro variables, again if you look at more deep dive, with the current account deficit has been rising, thanks to mainly the high oil price that we have seen in the recent past. It essentially is impacting the overall macro variables. Although we have seen some kind of micro variables showing an improvement, largely driven by the domestic led growth, which is on the investment that is being done by the government of India in terms of public sector spending. And second is rural consumption has also been showing an uptick, which also is in some sense it's reasonably visible. But with all those things, the macro variables have been more challenging both for India as well as global market. And the money managers have been facing a tough time. And this, of course, we always have seen this for the last so many number of years. We go through this period of outperformance and underperformance, and then the challenge that we face in terms of picking stocks as well as picking securities in the bond portfolio. We always go through this pain after every alternate 3 years, 1.5 years of time period. We go through this pain, which I think one has to accept this fact and have some kind of fight that once the oil price settle down at a lower level, then also the government spending ultimately will lead to a growth coming back.
Is the bull market in mid and small caps over?
I think we see as actually interestingly we had discussions last week. The way I think the stock prices have fallen, especially in the mid and small cap, there are multiple reasons are there for that. Some of the reasons are the FIs have been selling in India, therefore he always prefers to sell the tail stocks, the tail portfolio. So, essentially will not have much impact on the portfolio for his point of view, but definitely have an impact from the stock price point of view in the market. So, that is one reason. Second is the money managers have to adjust the portfolio. Post the recent guideline that came from SEBI on consolidation of schemes, people have to adjust their portfolio. And third, of course, the large portion of the PMS investors, because the lack of tolerance, I call it the tolerance for fall is low and happiness for the return, high return is very, very high. So, I think because of the two extreme of the expectations on the portfolios, also we have seen some bit of sell-off coming from the PMS portfolio as well. But having seen that, the way the stock prices have fallen, there is actually time to look at. We believe that worst is over as far as the mid and small cap concerns. Maybe it may wait for some time for it to actually give a bounce back, given the fact that people would like to see the results coming in the next few quarters, as well as an rising interest rate scenario when the macro variables are not that robust at this point of time. Maybe people will wait and watch. But having said that, it's time to actually for stock pickers, and if you have a 3-year time frame, it could be worthwhile actually going deep dive and looking at stocks rather than looking at any sectors and so on and so forth.
But Bala, as a fund manager, while I know that SIP money is long-term in commitment nature, but do you worry that if the mid and small cap selling escalates any further, there would be redemption pressure, which up until now is not really witnessed across mutual funds?
I think one big change the trend that we have witnessed in the last few years, the acceptance for staying invested in mutual fund with the clear long-term purpose has only been growing actually. Okay. So, I think the confidence is growing. The way I think we have also been giving the messaging both at the industry level as well as at the individual fund house level, that during a volatile time stay invested and hold on to investment for long term. I think the acceptance is very, very high.
Okay.
And second is in terms of redemptions. Though we see some kind of redemptions, people are deeply in money, they will of course like to actually take the profit. But I think most of the things that in the industry is moving towards structurally on the positive side is about building an SIP as a book. Therefore, you see actually the SIP book size growing. The lump sum as a percentage is coming down, and the people are making money actually also is moving out. But net if you see, I think we are only seeing an inflow rather than seeing an outflow as a industry level.
But as a fund manager, it must be a tricky time, right? Because you don't know whether to profit take from small and mid caps where you're in the money, to add more into large caps, or buy this decline that you're seeing in the broader markets. What is it that you're doing tactically?
So I think one of course tactically is the money manager's point of view. One of the job for us to actually outperform the index. That's first and foremost the mandate. And second is within that look at actually sectors that could outperform the broad market. And one of the things money managers have done at tweaking even our own portfolio is increase your weight towards where there is element of risk, less risky, keeping in mind the macro variables such as in IT, such as in pharma, such as in retail oriented banks, and such as actually consumer driven companies. That's why I think they all have adjusted their portfolio. In our own case, that's why all adjusted the portfolio. And having done that, given the size of the fund, even a money manager will be finding it extremely difficult actually shift your portfolio significantly from one stock to other stocks. The kind of swing that in a small portfolio you can bring in is extremely impossible actually in a bigger portfolio to do a swing in the portfolio action. I think one can only actually reduce the risk in the portfolio by doing the allocations here and there. And the same thing which we have money managers and mid cap fund also will have. I think one of the things that has got redefined in the recent past, there is a very clear definition has come for the large cap and mid cap and small cap. The large cap up to say market cap of 40,000 crores will be considered as a large cap. Between 40 and roughly about 5,000 crores will be considered as a mid cap, and below that will be considered as a small cap. Therefore, the money manager's point of view, he has to walk the talk by being within that boundary. Even if he likes say large cap company is doing very well and he likes the stocks in the mid cap by the mid cap portfolio manager, he cannot jump the gun and then buy the large cap names, given the fact that he has to walk the talk when managing his portfolio. Which will actually bring in huge benefit for the investors as well as for the portfolio managers in the long run. We may go through some kind of pain in the short term, but the benefit will be seen only in the long run.
But as a money manager, Bala, are you signaling to the market that, and to investors that be measured on returns? I see you're highlighting that you see about 16 to 18% FY19 earnings growth. Now that's been a wish for market participants for a really long time. It's never really come true.
That's right.
What convinces you that returns can match earnings expectations this time around, this year around, especially at a time when the first half has been so challenging?
I think I think as you rightly put it, the expectations the last few years have been pretty robust, especially in the earnings growth. What the companies have been delivering have been far below the expectations, which in our belief is it cannot continue beyond a point. At the end of the day, every company goes through a consolidation. When it comes to the question of managing their resource planning and balance sheet and the way the business model is built, look at your cost structure, every company goes through that every point of time. I think one of the point, if you look at in the last few years, I think first time ever, the census companies have reduced actually the overall debt in the portfolio. I think most of the companies have been actually repaying the debt, which essentially means that the reduction in debt will lead to a reduction in the interest cost, therefore increase in the earnings, boosting the earnings. This is I think the trend that we are seeing. If you also look at the coverage ratio with respect to their EBITDA versus the total debt, also have been showing an improvement, which essentially means the balance sheets are now getting more and more better. Then any uptick that could come led by the rural consumption going up, and the good monsoon could also lead to a better agriculture output and the stable inflation. And we also don't see significant pressure building up on India on macro variables such as an oil price going up quite significantly, which I think doesn't seem to be at this point of time. It's continuously on the rise, or maybe is going to threaten the global economic growth. I think if you're able to see some kind of semblance over there, and also the political risk, geopolitical risk, which used to be one of the big factors for global flows into the equity market, if they also get reduced to some extent, and then the question, I think a lot of people will have more time actually look at the earnings rather than actually tracking the macro variables.
But what does even a good, half decent earnings performance this year mean for returns? Because for a lot of viewers tuning in and listening to you, you're one of the largest fund houses CEO, they are perhaps wanting a signal from you on how reasonable they should be on return expectations given the investments that they're making in mutual funds. Because 2017 has spoiled generally the broad view that people have on MF returns.
See, I think the expectation on equity schemes, because you should never set an expectation for on a year-on-year basis. I think we should always look at return on a 3 to 5 year time frame. And having said that, having seen the last year, relatively poor year, and we may probably see the market remaining range bound for somewhere period of next 6 to 8 months kind of time frame. Given the fact we also have an next election, and as mentioned about earlier, macro variables are a little uncertain, but this is time actually of consolidation. This is time of consolidation. The return expectation from the equity investor point of view have to be nominal GDP plus 3 or 4% over a 5-year time frame. Having said that, investors also have to look at fixed income as an asset class. I think one of the factors which generally missed it, mutual fund means we always think actually is an equity. Not necessarily the mutual fund means only an equity, and the mutual fund also means provides an opportunity to participate to the fixed income schemes, especially when the interest rates are rising. It provides a greater opportunity for investors to look at the mutual fund fixed income schemes, given the fact that the banks are not today under tremendous pressure to increase the deposit rates due to their credit growth has been very, very poor. So, one side the banks have got the pressure on credit growth is not coming, and deposit growth has been growing.
But
And they can't give interest rate.
What are you telling investors right now for the next 1 year? And since we talk about markets on a daily basis, I have to take a shorter time frame than that. Would balanced funds be a higher portfolio allocation, and would that be a prudent strategy, or would you say it has to be a mix of a multi-cap and balanced portfolio?
So, the way we set the target in the beginning of the year, even during one of our investment voyage, clearly the allocation between equity and debt have to be somewhere in the range of say 50 for equity and 50 for debt.
Okay, so you're not changing
so
that.
you're not changing that.
Okay.
Second is within the equity component of your portfolio, the large proportion of your money should be in the multi-cap. So another way, when I come to the investing in stocks, I am looking actually at longer term growth, and the balance fund of course helps in hedging the risk without giving the leeway to the money manager to take a cash call, but asset allocation take the cash call, and therefore actually better off in investing in the balance fund, which is the pure balance fund. And having said that, it has to be a mix of multi-cap and some bit of balance fund, which is the hybrid equity oriented balance fund, and second is some portion of mid-cap, which is actually for long term. I think one factor which everybody has to understand, on each of the asset classes, they tend to outperform the market with significant margin over a longer term. Mid-cap actually gives a significant outperformance to the large cap over longer term, but the short term, yes, it can give a significant underperformance as well.
Bala, are there any redemptions in any of the schemes? Because last 3 years we've seen the good part. When I say good part, we've only seen good returns in mid caps, small caps. But for the first time, the returns are going to be negative. The tax structure has changed. You made a great point that the tolerance towards loss is always very low, and that's the investment psychology. Suddenly the portfolios are down 10-12%. So are you getting a sense that not in large schemes but the smaller schemes, if not today, maybe tomorrow redemptions will start?
So I don't think so actually, because one good thing that is happening for the industry is there are two type of investors. One is the existing investors who go through this, but mutual fund still remains extremely underpenetrated. Therefore, the number of new customers who are coming to the mutual fund continuously year after year have also been the rise. Therefore, you will see always the mix. You will never get that number right.
So the trend of the SIP culture, what we've seen in India in last 3 years, where on a monthly basis 8 to 10,000 crore is coming, and touch wood, I mean that's a great number. I feel very proud when I see a number like that. Do you think this is a multi-year trend, and this trend is not going to break irrespective of what will happen to markets, elections, macro, oil? Do you think there is reason to believe that just how 401k started, a phenomenon started in the 90s in US, you will have the SIP culture in India which has started 3 years ago?
Yeah, definitely. I think the biggest fundamentally sound structural change that has come for the industry is actually the building an SIP book. The SIP book for the industry as a whole has been growing each year by roughly about 1,000 crores per month, and that's been growing every year. Every year, the industry has been adding close to about 180 to 200 crores per month in SIPs, and all of them are coming from the new investors, and some of them of course come from the existing investors who actually want to get more and more SIP oriented way of investing. At the same time, there is another structure which also is building up, which is called, we call it an SWP, which is the systematic withdrawal plan. But given the fact that the monthly requirements of investors are not currently being met by investing in fixed deposits or investing in fixed deposit or any fixed deposit companies, they also now prefer to actually come through the mutual fund and fixed income schemes, and then have their monthly requirement plan through the systematic withdrawal plan. These are two concepts in my view will actually help the industry to structurally become more and more stronger in the long term.
Well, we have to talk about it. I think next week is going to be a very special week for all of us. AMC and ET Now present the Jan Nivesh campaign, and Nikunjan, you have been in talks for a long time regarding this. Tell us more about the endeavor and the kind of breakthrough you expect with getting every average Indian to spend in the market, to invest in the market through this program.
So, I think one has to always look at what are the investment opportunities that exist today. You take any asset class in which the investors can invest across the country, whether it is real estate or is gold or stocks or fixed deposits or any fixed income carrying instruments such as bonds or the mutual fund schemes. I think if you look at in all these asset classes, the mutual fund actually provides all the benefits including the convenience. Mutual fund should not be looked at only from the return point of view. It provides lots of convenience, safety, as well as at any time you want the money, you can get your money with the relatively lower cost. Whereas dealing with most of the other asset classes, leave aside of course fixed deposit, living with the most of the other asset classes is extremely difficult. Even I have been a fan of investing in real estate, but when I look back, all the investment that I have made on real estate is significantly lower than what I would have got even in fixed income schemes or mutual funds. Yeah. So that's a fact. And second is another factor I think one has to keep in mind. Increasingly, the country as a whole will go more towards higher tax compliance. There is absolutely no way, I think no individuals can live in the country with evading tax. Therefore, more and more tax compliance, if it increases, then you need to also look at the asset class that can give you tax adjusted return. And globally, one of the factors that the most of the investors do count apart from the market return is the alpha ability of the scheme to generate alpha through a tax adjustment. The tax adjustment can give you extra return by about 1 to 1.5%, whether it is in equity or in debt. That can never be ignored. Therefore, from investors' point of view, I would suggest or maybe I would expect investors to look at the mutual fund kind of product from the long term investment point of view. That's not just only my wish. I think that could potentially be the reality, and given the fact the way the financial industry is actually undergoing a change.
And that's exactly our endeavor at ET Now as well. Of course, Bala is going to be a crucial part of this endeavor, Jan Nivesh, but details of which we're going to disclose to you only come next week. Okay, quick check on what the market is up to. Bala, pleasure having you. Thank you so much for taking the time out and joining us today. Always good to chat with you.